One of the topics that is on so many people's mind is inflation. You can't really see it, but it's affecting everything. So, is inflation permanently coming down, or is it about to rebound? Let's talk about this and what happens if it does rebound and what assets do best. Okay, stick around, we'll talk about that and more. Hey everybody, RC Peck here with Fearless Wealth, and this is my weekly video where I deconstruct the market and look at what I believe is most important. Now, here's the thing. This is kind of fun to look at this information. The key thing to retire strong, and that's what I do at my company, Fearless Wealth. We manage people's money. It's about retiring strong. That means making sure you own the stuff that is going higher. The old rules of always having 30% in bonds or 40% in bonds or 20% in bonds, that doesn't work anymore. Even in the '08 crisis, the 2008 crisis, that 60-40 portfolio, yes, that 60-40 portfolio fell somewhere between, depending on which one you had, somewhere between 38 to 47%. For reference, the NASDAQ 100, that's the Qs, only fell 51%. So bonds have become a dangerous place. But the key thing is, if you want to retire strong, is to make sure you're on the right side of the market. So I say this, and I say this each week because I want to show you what I'm looking at this week. But what's most important is actually the implementation and the strategy, right? You don't own the symbol, you own the strategy that owns the symbol. Okay, so with that, the first thing I want to look at is something called credit default swaps. So let me do this. Let me move over to my screen now and tell you why this is important. So this is a price chart of Bank of America's credit default swaps. Now, a credit default swap, a CDS, is basically insurance on a company's bond, right? So if you are worried about a company's bond going bad, you buy insurance on it called credit default swaps. This is a price chart of Bank of America's credit default swaps. You can see they're going higher. Now, there was that big peak. That was the COVID peak right there. Honestly, it was just a little bit before the COVID peak or the COVID crash when the stock market fell anywhere between 30 and 35%. But what I just want to point out to you on here is that people are starting to worry about Bank of America. So we want to know what's going on. Now, here's a price chart of Bank of America. Now, itself, you could either call that a double top or a triple top. It's down about 43%. More importantly, it's down below its pre-COVID peak. This thing, and here's what's crazy about this. There is more government backing with B of A than almost any other company in the United States. It looks horrible. It's down 43%, but that's not even the story. The story is it's below its pre-COVID high. This is one of the 5 biggest banks in the US. So look, the banking thing, whatever it's going to be called, looking back on it, is not over. It is not over. Okay, so that's the first thing I want to point out to you. Second thing I want to point out to you is Warren Buffett. This is really odd. The guy's like 90 years old. He got on a plane, went to Japan, and met with the CEO of those 5 companies you see highlighted on the screen. Mitsubishi, Sumitomo, Mitsui, Itochu, and I can't even pronounce them. They're 5 big Japanese conglomerates. He had 5% ownership of each one. He increased his ownership to 7.5%. And then he met with the new, basically, Jerome Powell of Japan. Now, here's a price chart of Berkshire Hathaway. This is its B shares, which are 1/30th. I believe I'm getting that right, of its A shares. Not that bad looking. Like most everything else, is just kind of, honestly, in a sideways doing nothingness. It's gone sideways for about 2 years, and lately it's looking strong. There's a little overhead resistance. Now, I bring this up because this guy knows more about banks and bank failures than probably anyone living. He got a sweetheart deal with B of A. I think he helped him out in 2011, maybe even 2008. So why did he go to Japan? I think he's worried. And the reason I think he's worried is because I was reading some other things from other analysts saying, I bet you he thinks the yield on the Japanese 10-year is going higher. And if it does, that is an inflationary mess. And I just want to quickly show you that before I move on to the next thing. So let me go find it here. It's right here. This is the yield of the Japanese 10-year. That yellow zone was its sidewaysness. That red horizontal line was 0. That means for years, 6 years, the Japanese government was paying you 0%, and even in some cases, negative 0.25% to have a Japanese 10-year. And now the yield is going crazy. It is spiking. The Central Bank of Japan, which is the Bank of Japan, they're losing control of the yield. And this is probably why he flew over to be like, hey, what's going on with the yield? Are you going to increase it again? You can see they're basically giving it this bound of 0.5%. If this moves higher, that means inflation is going to be much, much more stickier. That's a pretty big deal. Even if you've never been to Japan or don't care about Japan, the fact that if these yields finally start breaking up, and they are, as you can see them, they are moving up. They bottomed at the end of 2019 at about a negative almost 30 basis points. And so this is very volatile, and that's why why Warren Buffett probably went over. So that's the second thing I wanted to just show you is this is about inflation, and that's a great inflation chart. It's not my last inflation chart I want to show you. I also want to point out that there is a lot of money leaving bank deposits. Yes, I know there's like $17 trillion in deposits in the United States. But when banks start losing their visibility on what their deposit flow is, they start lending less. And this price chart goes back to 1973, and it's the change in bank deposits from peak. And it doesn't look good. Something is different here. I think you all can see that. They haven't changed the way they measure this. Something different is going on, and this is just not Silicon Valley Bank and Signature. People have figured out that deposits pay 0% and money markets pay 5%. And that is not good for the banking industry, which is what this price chart is. Now, I know it kind of looks like B of A because B of A is a big part of this, but the banking industry in the US has a very similar problem as B of A. It's below its pre-COVID high, not a good thing. Now, it is doing its best to break higher, but the banking industry itself is down about 45%. So that's going to put some headwind on the stock market, right? Because when banks stop lending, people stop borrowing, which means the economy starts slowing down. I have two more things that I want to show you, then I will wrap this up. Okay, this came from Octavio from, I don't even know how to pronounce this, Crescat Capital. And he was just pointing out like this was the inflation in the 70s, which I think most people forgot. They knew inflation was high, but they didn't quite know what it looked like. And he put out this price chart. And I think it's a pretty neat price chart because here you see inflation right around 2.5%, moves up to about 6%, falls back down, spikes way higher to 12%, falls back down, spikes to 15%, and finally falls back down to about 4%. That is volatility. That creates a lot of instability. The stock market itself fell 50% in 73 and 74 during that second spike. So that is not good, meaning it creates a lot of instability. Now, what I want to show is gold. This is the last price chart I'm going to show you. So here's gold, and I'll just show it to you here, between 1970 and 1980, right? So now it was suppressed or unnaturally kept at $35 an ounce, but it finally made it up to about $850 an ounce. Lots and lots and lots of volatility. And one of the things that did best in the 70s, I know we are not the 70s today, we have cryptocurrencies and other things, but the market has memory. So now you can see that it went from 35 to 850. Fast forward to today, and you have gold sitting above its old high in September of 2011, and it is making a run for a lifetime high move. Not many people, I think, I mean, some people are talking about it on Twitter, but it's nowhere near, I think Bitcoin kind of sucks all the oxygen out in the room. Here it is today. Now I'm recording this video Thursday after the market closed. So Here's lifetime high. This is gold in US dollars. So it's at its second highest daily closing ever. And so the question is, it has to stay really above. It has to break above the kind of this blue zone. If you're looking at the screen here, the blue zone is basically, let's call it $1,950 to $2,050. If it breaks and stays above that, expect gold to really move to 3,000 pretty quickly, 3,600 after that. Those are based on Fibonacci retracement or Fibonacci extension lines and a few other measurements. So we definitely have some things moving here. And I think what's driving it is inflation. So yes, inflation has come down from that 9%, 5% right now. But it does, people have this presupposition that inflation is just kind of it's just nice. It's gonna be this nice, beautiful bell curve, and then it's just gonna flatten out, and then we're gonna be back to our, that's not how these things work. And it's certainly not how it worked in the 70s. The 70s was very volatile for the stock market. It was very volatile for financials. But that one place, gold, is where people are like, look, I don't know what's gonna happen, but I'm getting some gold. That may be happening now. That may have started. I mean, you can talk about where it started. Gold bottomed as far as where it bottomed in the most recent 20 years. It bottomed in 2015, at the end of 2015 at 1,040. It's about double, not quite. Call it 2,080, which it's not quite, but it's basically doubled and no one's really paid attention to it. So let's land this plane. We've got volatility. It's not showing up in all parts of the market right now. We have the stock market generally just going sideways. We have the banking sector, I don't want to say in turmoil because it sounds like it's in turmoil. It sounds very hyperbolic, but it's not doing well. You got Warren Buffett flying, from Omaha to Japan. Yes, he does it on his net jets, but it's like 18 hours in the plane. That's he wanted to see what's going on in Japan, I believe, based on what I'm reading, to see, hey, are you raising your interest rates too? Because that's going to create more inflation around the world. And then finally, what that leads to is, I believe, gold possibly spiking. And I think it's when it breaks above its high and not if. And then the impact it has on the broader markets. Thanks everyone for being in my world. I appreciate you watching my videos, leaving comments, subscribing, all of those things that help out. And I will see you next week. And if you want to have a portfolio x-ray, it's where we look at your actual portfolio and we find something that is so important to people's futures. What we find in a lot of portfolios is something called downside replication. And it is not good for retirements, and almost no one is talking about it. You do not want downside replication in your portfolio. If you want to find out if you have it, go ahead and go into the description and you can get on our calendar. Thanks again, everyone, for being in my world, and I will see you all next week. Okay, bye.